Joining me now is Northlight Asset Management's Chief Investment Officer, Chris Zaccarelli. Chris, good to see you. Thank you so much for being here. We are on countdown mode for the big, beautiful bill and then countdown mode for the June jobs report. What are your expectations here, and what do you want to do with your money in the face of all of this?
Yes, we do expect the bill to pass. It's possible that based on the changes that the Senate made, it may take a little bit longer. It's possible the House may need to make some adjustments. But if they're able to pass it this morning and be done before July 4th, I agree. I think markets will really benefit from that. Clearly a lot of this good news is priced in. Markets are at all-time highs, as you mentioned. Valuations around 22 times earnings, significantly above the 17 times 30-year average. So a lot of good news is priced in, and we believe that news is positive for sure. Having the extension of the tax cuts passed, having a lot of the spending cuts in that bill will be really helpful for the economy and for businesses. But to your point, we are looking at the jobs report as well. Yesterday, the ADP report was a disappointment. So we're looking at the jobs report to see if that was an anomaly or if there's some type of a trend that's changing. With unemployment at 4.3%, very low, that starts to tick back higher, that could be a concern. But at least right now, we have a lot of things going for the market, and that explains why we're at all-time highs. So with markets at all-time highs, I think if you can see the economy continue to expand, we'd be looking to get into cyclical sectors, such as the industrials, looking at companies like Caterpillar, United Rentals, companies that we think will do well if there's increased spending, development, and a lot of things that will come with all of the good things that are in this bill, as well as an economy that continues to grow.
So do you want to allocate money to the areas where President Trump is emphasizing and prioritizing, such as, for example, defense?
So, we think defense stocks have already been given a lot of opportunity to run this year. I think, given all the geopolitical problems that we've had, not only in Ukraine, but also in the Middle East, we do think there's room for those companies to run. But again, a lot of the forecasted future spending on defense is most likely priced in. So we're still positive on defense stocks. If you own those, we would hold them. We wouldn't necessarily add to them aggressively at this point because we think there'll be better opportunities along the way. However, we would also point to European defense stocks as well. Within the U.S., that story has been told. But if Europe does commit to some of the things that President Trump has asked them to in terms of increasing NATO spending to 5% of their GDP for each individual NATO country, that could be a boon for defense companies in Europe. So that's one area we would look to at this point in time, based on everything that's already priced in.
Yeah, I mean, we're waiting on this vote to begin on the big, beautiful bill. We're expecting that the vote will begin between 6:30 and 7 a.m. But much of Wall Street and the business community is expecting this bill to pass. And if it doesn't pass, we could see a real disruption in markets. And that's one thing that the chairman and CEO of Bank of America told me just a few weeks ago. Here, watch. As a business, as someone talking to your clients all the time, is this a front center issue? Getting those tax rates extended, ensuring they get this bill over the finish line?
Well, there's an assumption they'll be extended so much, though, that if it didn't get extended, it would be a real shock to the system.
A real shock to the system. We've got yields below 4.3%, Chris, in terms of the Federal Reserve, and we're waiting on the jobs number this morning. Do you think if we get another weak jobs number today, on the heels of the ADP number yesterday, that moves the Fed to cut rates?
I think it definitely would be another data point that would make the Fed a little bit more likely to cut rates. I don't know if this one report would do it, but absolutely, if we have a couple weak reports in a row, that's the one thing that will get the Fed's attention. They've been focused a lot on inflation, the potential impacts of what the tariff rates would do to the overall inflation rate and to the economy. But you can also tell that they're focused on their dual mandate, of course, which is on the full employment. And so a weakening in the job market, I think, is one thing that would cause the Fed to move a lot more quickly than they're currently planning to move. Right now, it looks like they're still waiting to the second half, which we've just begun this week. But maybe in the late Q3, early Q4, they might do 1 or 2 rate cuts. If the job market were to deteriorate much more quickly than that, I think you'd see them move more aggressively. They could potentially do a 50 basis point rate cut, and they will definitely do more than 2 rate cuts this year if the job market does weaken. So that is one thing they'll be looking at very closely, I'm sure.
All right, Chris, great to get your insights. We appreciate your time. Chris Zaccarelli joining us. Thank you, sir.